It's time for Mastering Your Money with Gary Mastrodonato.
My good friend Zig Ziglar once told me, Gary, people don't really care how much you know until they know how much you care about them.
Every week, Gary brings you up to date in the world of finance and gives you tried and true retirement tips from his office at the Masters Wealth Management Group in Oriental, North Carolina.
It's the decisions you make in life when you have a choice that will determine where you'll be in life when you no longer have a choice.
For 40 years, Gary has passionately served his clients, helping them retire with confidence.
You know, we treat all of our clients the absolute same. There are no minimums here at the Masters Wealth Management Group.
Now, let's put the wind in your financial sails and your success. Here he is, the master, Gary Mastrodonato.
Well, hi, everybody. Gary Mastrodonato, the September edition of the Mastering Your Money program. We're in the third quarter almost, and it's amazing how fast this year has gone by. But it's a pleasure to be with you in our 45th year of practice, our 43rd year of radio, and we're going to have a little celebration as now we just entered year 46 officially, Jeffrey, on September 1. 46 years ago, the master wrote his first piece of business for the company, and here we are on a roll, continuing the great work we do to help American workers in the United States of America. So it's always been a pleasure. You know, today's show is no different. We're going to have reasons why you need to talk to the master here. If you're retired, about to retire, you're in retirement. Have you covered all the boards in your retirement? What I mean by that is, have you maximized your Social Security? Have you maxed out your 401k options for lifetime income plans to take over the check you're leaving behind when you leave work for the first time? Have you maximized out your savings money that you've saved along the way to start using and putting that away for a income translation, an income conversion, if you will? Have you taken the time to think about a plan for long-term care? If you live too long or even die too soon, what happens to your family? What happens if your spouse, if you drop dead in 3 days from now? Will they be able to stay in the same house, or will they have to move out and move in with maybe one of the children, or move in with a brother or sister, or size down and sell the home and maybe get a smaller apartment somewhere? There's a lot of things that you need to think about when you get into the retirement sector of the show. We talk about retirement distribution, which, ladies and gentlemen, is a totally different language than retirement accumulation. Very few people that are advisors, professional financial advisors like myself, are properly trained in the area of retirement distribution. It's an art and a science. It's math and science. It's how long you're going to live and the math that goes with it. We're mathematicians here. I am. And, you know, it helps out a lot when you know the numbers and how to get to where you want to be to make sure that you never, ever run out of money during your lifetime. So that's going to be part of the show today. And another part we're going to address that we haven't done in a while is tell you a little bit more about the master. What got me into this business in the first place? Who am I? Why am I talking to you for 43 years on the radio? And what's the message I'm trying to get over to our listener, so that you may pick up the phone and have us help you. We've helped over thousands of people in my 46-year career now, but we want to be able to help you. I know you're listening out there when you call. I hear the same thing over and over again. We've listened to you for years, Gary. We're now retiring. You should have called me years ago when you first hear the message, because the best planning is the planning we do ahead of time, but we have to pick it up wherever you left off. And in many cases, you never started in the first place. So we're going to let you know what the difference is between having a financial advisor who knows what they're doing with retirement distribution and just somebody that's trying to sell you a product to accumulate money and move on to the next client. Big difference, big reasons why you want to listen in today. The Mastering Your Money show continues right after our celebration and our honor to our heroes, our men and women in uniform, our people that keep us safe year-round. We honor them every show for the last 43 years, and today will be no different, along with our veterans who we see all the time all over towns that we're in, whether we're in Oriental or Naples, Florida, or Goldsboro, Greensboro, or Greenville. We honor our heroes right now, our veterans and our people in service. Let's take a pause right now.
And I'm proud to be an American, where at least I know I'm free. And I won't forget the men who died, who gave that right to me. And I gladly stand up next to you and defend her still today. 'Cause there ain't no doubt I love this land. God bless the U.S.
We're back. Gary Masterdonato, Lee Greenwood, God bless the USA. Always a pleasure to have him on the air. I wish we can get him live sometime and just thank him for the beautiful work he does and the song that he sings, and most importantly, honoring our heroes, our men and women in military and our veterans who got us to where we are today to honor the flag. And I like what President Trump's been doing about punishing flag burners, or proposing to punish flag burners. In many cases, yes, it's their First Amendment rights to speak out, but it's desecration to the American that we love so much. America, our home of land and sea, our opportunities are all here. There's never a better place to be. And as the president said it many times, if you don't like it, get out of here, because we got plenty of people that want to come in the door, as you've seen. Nevertheless, pleasure to be with you on the program. We are retirement distribution specialists. If you're not sure what that is, we help people retire when they're at or near retirement, and we address all the main things that we want to discuss on the program. And first of all, let me bring my co-host on, Mr. Jeff Shade. He is my rock and my levitator in life, if you will, because he keeps me sane. He keeps me online. He keeps me straight, and he always keeps me on point. And when you hear a good show, he's the guy you thank. You don't thank me. I mean, I'm just doing the words. You thank Jeff Shade for all he does with him and his team, and the beautiful editing and putting the music beds in and putting all the little sound effects in that he uses. Thank you, Jeff Shade.
Thank you so much, Gary. And it reminds me, years ago, I don't know if you remember Tom Snyder, who used to do the Tomorrow Show. Yeah. He was local anchor at NBC in Los Angeles, but Tom used to say, no bad hosts, only bad producers. So
that's true. I've had some bad producers along the way, and I can tell you, they're right. They can take a good show and make it very bad.
Oh, yeah. No, but Tom was a great guy. I very much enjoyed working with him for a short period of time. But it is a real pleasure working with you here, Gary. And you said something interesting in the beginning of the program here is how long you've been on the air? 43 years. 43 years on the air. You've been in business 46 years. A lot of people are, I would hazard to say, Gary, most people do not last in any profession that long unless they have been doing something special. So I wanted to ask you, 46 years of success in one business is quite extraordinary. What have you done? What has been your philosophy that has carried you through so long?
Well, my philosophy is doing the right thing at the right time for the right client. All the clients are the right client. We just need to make sure that we fit the right solutions to your problem. Everybody has a problem. You think you don't, but you do. And I've got problems, certainly, and I know, Jeffrey, you've got a couple here and there. You hide them well, but we all have a problem. We're all human beings. Mm-hmm. So, but, you find the problem, and, the problem that people face, the American worker faces, is they want to make sure that they never run out of money once they retire. It's hard to get them out the door in the first place to retire when they're healthy, because they're used to getting up in the morning, doing the routine, and going out. But what happens when you're old enough to, or sometimes, a company has a policy where at a certain age, you're kind of mandated to leave. For example, American airline pilots, we have a lot of their pilots on our client list here. And when they're 65, they are asked to no longer fly. So it hurts them because many of them are sharp as can be, but they're not allowed to fly anymore. So now they're taking mandatory retirement. Some people have that situation, others don't. Some people take it earlier. Some people take it later if they can. I've got clients that call in that are still working in their mid-70s because they like working. Many of them need the money still. They hadn't saved enough money for retirement. So what do we do in those cases? And how do we help people along the way? So we always sit down with a new client when we start. We always offer on the show, and today will be no different. We're going to offer a complimentary 22-minute interview the first time through with the master. You'll call us at 252-249-0100. That's 252-249-0100. A very lovely person, male or female, will answer the telephone. And you'll ask them for an opportunity to speak with me, and they will give you some open available times, and you'll pick the best time for you. They'll jot it down. They'll notify me on the time that we're talking, and then at the appropriate time, I will call you at that time, and we'll start right in and get some information on you. We'll just talk very, very casually. There's no hard drive, no selling, nothing like that going on. We're just here to help you uncover some of the problems that you might have and the reasons that you called in the first place. What motivates somebody to call varies from person to person. It always behooves me as to why somebody would call, and it behooves me more as to why somebody would not call, because some of the things that we offer on the show are incredibly amazing, And why they wouldn't call, I have no idea. I mean, it's like wanting to hit your head against a wall many, many times. You know it hurts, but you just keep doing it. And you got to get to the point of like making some changes in that approach. So when you call, we'll get a little information on you, what part of town you live in. Are you in the Carolinas? Are you in South Carolina, North Carolina? Are you in Florida? Are you wherever our show plays? Wherever you hear our show, you can be in Virginia, anywhere. It'll play and you'll hear us, and you have the right to call us. We have licenses in all those areas, and we will chat with you about your situation. So that's number one. Number two is we want to be able to, if you're at or near retirement, or if you haven't done this yet, we want to take a look and see what your Social Security might look like if you're to retire at 62, maybe full retirement at 66 or 67, somewhere in that gauge range. Now it's, as people get older and people are calling in now, they're more closer to full retirement age, which is 67. You can take Social Security at age 62. The maximum age you can start it at is age 70, and the longer you wait, the greater that amount will be. And there are certain exclusions when you're working and collecting Social Security if you earn over a certain amount of money that you started collecting before full retirement age, and then you have to give some of that money back from the Social Security checks you're getting and put it back into your account, if you will. It'll always be your money, but they take your account money and spread it out over a 10-year period. So if you gave back $1,000 a month, you're not going to see anything near that going forward when you finally do take Social Security and turn that on again. So you got to be careful when you choose it in the first place. We don't want to leave money on the table. So we'll help you out with that. That's number one. Number two, we want to maximize what you're doing with your retirement savings. If you're in a pension plan and you're lucky enough to have a pension, we want to make sure if you're going to take that choice of pension that you choose the right option at the right time. Many people take pensions, they'll sit down with the HR person and say, well, I'm going to retire next month. Yeah, just give me the highest amount of income I can get. That's life only. So they'll take the life only option, not understanding the life certain option, maybe carrying some of that income over to the spouse, and they'll just look at the amount that they're going to be getting. They'll say, well, for $300 a month, I'd rather take life only, and they'll take the life only. The sad part is if they die the next 2 years or 1 year or 10 years, it doesn't matter when, the income stops, the spouse gets nothing if you have a marital spouse. So that's something we have to go through with you and make sure you understand the options and help you make that right choice, because once you make the choice, it's irrevocable. And what that means is you cannot change the choice. So it's in writing, it's in stone, it's in steel. You can't change it. So that's the second thing we look at. If you're lucky enough to have a pension plan, if you're military, you work for the government, you work for a school system, you're a teacher, many of the government employers and many of the state employers have pension plans. If you work with them long enough, you'll have a pension number that's coming in. In addition to the pension, you might have saved money in your 401k or your 403b. If you work for a hospital or a school system, that is a nonprofit organization. If you worked for the military, you got a 457 plan. If you work in government, you might have a TSP, a thrift savings plan. They're all kind of the same thing. They're all 401k plans with a different name on it, a different brand on it. But that's what it is. It's a 401k plan masked in a different suit because of the fact that you're in a different scenario. But they all work similar in the same way. You might have some IRAs as well. You might have some IRA money that you put money into along the way because you have the right to do that. You might have some traditional IRA that's taxed. You might have some Roth IRA money that grows tax-free. And we're going to show you what money to spend first, which becomes a big problem when you do retire. Most people spend the wrong money at the wrong time. So we set up an income plan for you immediately upon retirement that then earmarks the right money you should be taking out, because we have to respect the income taxes. Taxes are rising. Taxes are rising quickly. Even though we had a big major tax cut you might have heard about in the Great Big Beautiful Plan, there's a lot of hidden things in there that will end up paying more tax than less tax because we got less deductions than we used to have. So we have to take all that into consideration as well. So each case is totally different. We sit down and write these all out individually. You have a tailor-made suit, perhaps, for the first time, and that's a big advantage of having a financial advisor working with you, where you got tailor-made readiness to go from that perspective. And then we have to take a look at a plan for long-term care. Do you have a plan for long-term care at all in any format? What is your plan? Many people think, well, I have Medicare. They'll pay the long-term care. No, they really don't. They'll pay it for 100 days. if you need it up to a certain dollar level. But after that, you're on your own. And most people live longer than 100 days if you're on a long-term care need. So what do we do at that point? Now you're paying out 8, 10, 12, 14, 15,000 a month private pay in order to have that family member feel good about themselves, or it might be you where you want to have the care that you need and require and have the comfort level of that. And most people, in my opinion, that I've spoken to in the 46 years we've been in business, is that most people want to have the choice of where they're going to be. Many military people who have this all paid for think, well, I've got this done, it's paid up by my military benefits, which is true. However, they're going to send you somewhere away from where your spouse is going to be, because they're going to send you to a facility that's going to be one that fits you best for your situation, and it may not be in your hometown. So now you got to uplift the family, move the family out. You got to do different things like that. And we have a plan to avoid all of that and work around it all, and that's our special plan for long-term care. And it's not free. There is a cost to it. It's, when I show that to clients and prospective clients, they go, "It sounds too good to be true, Gary." I said, well, it's not too good to be true. It's just too good to be free. But we also find you the premium payer of who's going to pay the premium. If long-term care was free, everybody would be calling the phone off the hook, asking to be involved in that plan. And all of a sudden, there's a premium due, and you don't get the calls as much anymore because people know it's an expensive proposition to have that. Our plan is special because if you can't perform your daily activities that require and trigger the benefit, our plan will give you the death benefit, all in an accumulated format, all in cash and all tax-free, all at the same time, which is an amazing plan. They put the money in your hand. If we got $1 million worth of benefit, they're going to give you $250,000 per year tax-free, or the per diem rate. You choose what you want. You'll pay tax on some of it if it's above the per diem, but the government sets that. But regardless, you'll have that money available if you want to take it out, or you can stream it out as much as you'd like to have. It always goes to your family, so if you don't use it and you die, the rest goes to the family, and they get the lump sum totally income tax-free. So we got you covered on all of that. We cover the whole enchilada. We wrap it up with a legacy plan for your family to make sure that if you want to leave a legacy behind, that your kids, wife, and children have money to spend if something happens to you prematurely. We want to make sure there's legacy in place. And at the same time, we also want to make sure that you have money for charity contributions, philanthropic situations that might be favorable to your lifestyle. You might want to remember some people in the will, and then there's money to do that once we create the master plan. Sounds like a lot? Well, we do a lot, and we don't charge you a dime for the whole thing. So the number to call, 252-249-0100. Jeffrey, I'm going to ask you to give us a little 30-second spiel as what's going on as to how we do all of this and how we make it work special for you. And then the number to call again, 252-249-0100. We'll take a short break after Jeffrey comes in, and then we'll move on to the show and tell you why I, Gary Mastrodonato, have been in the business 46 years, and how the heck did I get in this business in the first place?
Thanks, Gary. What if you could get a record high bonus just for moving your retirement money into the right annuity? Well, new annuity products are offering some of the biggest bonuses that we have ever seen, designed to give your retirement a jumpstart and more guaranteed income for the future. Imagine locking in an extra 20, 25, even 27% in bonus credits so your retirement dollars work harder for you, not Wall Street. Call Masters Wealth today, 252-249-0100, to learn how you can take advantage of these record-high bonuses while they last. Once again, that number, 252-249-0100. Gary, it's time for a break here on Mastering Money. When we come back, we'll continue to talk about these record-high bonuses and more when our program continues right after this.
Hi, I'm Jackson Mastrodonato. Please listen to my grandpa. I'm the master in your money show.
We're back. Gary Mastrodonato, the Master in Your Money program. Big thanks to my grandson, Jackson Mastrodonato, for the introduction back to Grandpa here and asking you nicely to follow the Master in Your Money show each and every show. We play about 17 times weekly. You want to check our website at masterswealth.com and or go to our podcast and get a complimentary podcast on any topic you want. Jeffrey puts them up so religiously every week, and of course always has the topic of the show in place as well. So we'll educate you, no charge to you. We don't charge for the podcast. All you got to do is go in and request it, download a few. So when you're on your next travel trip, you got the Master playing in your ear. And there's no better voice to hear than the Master. It's soothing, relaxing. They tell me that all the time. Just don't fall asleep on the highway. That's all. It's very soothing and very relaxing. That's what people say to me.
Okay.
So it's just sharing. So anyway, thank you, Jackson. And we admire your tenacity. He just started football, Jeffrey, and he's a quarterback and a tight end. He's catching the ball and quarterbacking. He's got that left-handed throw that's right on the bullet.
Wow.
He's a good quarterback. He's got good vision, good athlete. Been working out at age 8, and I bought he and his brother Axel a helmet. Ladies and gentlemen, if you've got grandkids that are playing football or soccer, they're called Guardian helmets, Guardian Angel helmets or Guardian helmets on Amazon. They're only about $75 each, but it's a helmet that's approved by the league, and you place it over your normal helmet that they give you to protect your head. Reason? You don't want brain injuries in 8 or 9, 10, 11, 12. You don't want brain injuries at all, but at 8 or 9, 10 years old, not a good time to have a mini concussion from playing football. So you want to protect your head and the soccer as well, because there's a lot of roughness out there when you're in a field position and trying to score. There's a lot of players on top of you. It's almost like American football. It's getting rougher by the day. So nice tidbit for the grandkids called the Guardian helmet, and take a look at it on Amazon. The Master helping you keep your grandkids safe during football. And we do it all, whatever else you need done. I don't do dishes, however, but that's okay. So we're talking about, Jeffrey, you gave a nice little readout on the commercial on annuity bonuses. And let me talk about the annuity that we use, AAA rated company, of course. You want to be safe on your annuity. And the annuity, if you're age 74 or under, that we recommend is part of the Master Plan. And this also pays the premium for your long-term care plan, ladies and gentlemen, or helps pay the premium if you choose it to do that. As a bonus, if you qualify, you got to have the right suitability. It's not for everybody, so this is not blanket work here. But if you qualify and you're 74 or under, the bonus is 27%. Immediate payout puts it right into your account. So let's use an example. You come to see me with $1 million in your retirement plan in your IRA account, and you say, keep my money safer. I don't want to lose a penny of this. I don't want to go back to work when I'm 80 and the markets tumble down, or when I'm 75 and the markets tumble down, or even later on this year or next year when the markets may tumble down. I don't predict markets. I'm going to tell you this, sometime over the next, if you're retired at 65 and you're listening to the show and you're in your 60s or 70s, there's a great chance before you die that the market's going to correct at least once, if not 2 or 3 times, and those corrections will never come at the right time. They will correct swiftly, and there's bubbles out there already. You're going to see them in the next couple of months, and probably in the next couple of years, you're going to see major bubbles coming through. Markets cannot go up in a straight line forever. Right now, markets are at all-time highs. A great time to lock in the highs so that you can't lose any of that money, and you transfer it to the Master Plan and get a 27% discount. So if your account's already gone up 20% this year due to great returns in the marketplace, how about another 27% on top of that? And when you look at 12 months from now, you got a 47% increase in your retirement plan from what you had a year ago. That's called the Master Plan, and that's how we retire people 2 years earlier than you had planned on retiring. We talked about that on last week's show. And you can Google it, or you can go to the podcast and hear that show. Nevertheless, a 27%. So let's use an example of the math. You got $1 million in the account, 27% bonus. That's a $270,000 bonus. That's over $250,000 of bonus money immediately in your IRA account, in your pension account. We roll the 401k into the IRA. Now you got $250,000 you didn't have before. So now you got $1,270,000. If you just place it in our 4% 1-year guaranteed account, it's like a CD at the bank. Right now, the insurance company is paying 4.05%. You know, that comes out, just quick math, over $100,000 of interest. And that's guaranteed, by the way. It's not what if, it's guaranteed interest. Over $100,000 of interest in that account. And you've got all of a sudden a beautiful plan with a lot of money in it that you haven't lost a dime, and you locked it all in. So if we take some of the interest money and pay it forward to the long-term care premium, let's say we took $1 million of life insurance, and you got to be healthy for the special life plan we use. You got to be very healthy to get that. But if you're healthy, we'll get it for you. and let's say the $1 million is going to cost you $40,000 a year, just for a round number. That $40,000 will pay you $1 million if you can't perform 2 or 6 of your daily activities as soon as day one. You don't have to be in the plan 2 years or 1 year or 5 years. Day one, if your health changed overnight, you got a stroke or something occurred with your health where you need help from a family member, you don't need to be in a facility. But if you need help from a family member, that $1 million benefit will kick in, and all of a sudden you've got money in your hand that's totally income tax free if we set it up properly. And believe me, we do. So we do this every day. So now all of a sudden you got $1 million in your lifetime income plan for death benefit, or if you die too soon, your family gets that. And you got $1,270,000 in your retirement plan. And remember, before you came in to see me, you had $1 million. I mean, you had $1 million in your IRA, and you thought you had all the money in the world. The part you don't look at is the income taxes on that million. Because if you die tomorrow and that money goes to the missus are going to start taking money out to live on, and that money is going to be 100% taxable coming out of your IRA plan. Remember that, 100% taxable, which means that only half of the money that you're going to leave her is going to raise your tax bracket high enough. Only half is going to end up in her pocket. The other half, and Uncle Sam says, thank you, by the way. They called me earlier and said, thank all your listeners, Gary, if they don't listen to you on the master plan. I said, okay, what am I thanking them for? For the extra tax money. We want their extra tax money. So don't let them know how you do this. Okay. I'm not supposed to tell you this, but the IRS says don't tell you. I'm going to tell you anyway. You walk in the day after you listen to the show and you call us at 252-249-0100. You die a week later, your wife and kids and family are going to have $2,270,000. That's $1.2 million more than they had the day before. And most of that is going to be, more than half of that's going to be income tax free. The $1 million will be income tax free. The $1,270,000 has got to be taxed as they pull the money out. But remember, what a plan. What a difference it makes, and how it changes one's life is immensely valuable and important. That's how we retire, ladies and gentlemen. We can retire you 2 years early or even more when you follow the rules of the master plan, which we laid out and created a few years back. Because a few years ago, we didn't have these strategies in place. They weren't available from the financial side. They weren't available on the financial products. They are now. They're very special products. We know how to use them. We use them every day. Allow us to help you to help yourself. It's so crucial and important. But imagine earning $270,000 day one from the bonus at 74 or under. Good news is if you're above 74 and you go from 74 to 78, the insurance company, AAA rated again, safe as can be, will also give you a 22% bonus. So instead of 27, you get 22. 22% is very livable and will do almost the same things, except you're 5% shorter. On $1 million, it's $50,000 less. So why wait to go from 74 to 75 when you can lock it in at 74 and get the extra $50,000 on $1 million? So that's a sample idea of what we do at the Masters Wealth Management Group on a day-to-day basis. We want to keep your money safer. You can never lose a penny. Of all that example I just shared with you, if the market falls 50% next year, you lose nothing. Zero. There's no market loss for you. Actually, if you take the 1-year fixed guaranteed rate, you get that automatically. You're going to get the interest every year on the anniversary of that annuity. So 252-249-0100. This is an absolutely no-brainer at a 27% bonus and a 4.05% 1-year guaranteed fixed interest rate for the year. That's 31.05%, ladies and gentlemen, in your plan at the end of 12 months. You get the 27% on day one. You get the 4.05% on the whole $1,272,000 on day 365. You put it all together, and you got over a 31% return on your monies for the first year in the master plan. Year two would be whatever we choose it to be. You could be in a strategy S&P 500. You could be in a strategy of just another fixed amount for the year. And normally the fixed accounts renew at pretty much the same rate they are now, unless rates go higher or rates go lower dramatically. It'll be pretty much, the company's very good at trying to lock in the same amount for the client as long as they can, as long as possible. So it works well. Annuities are very safe. And I'm going to go back. I just found this annuity timeline that's kind of interesting. Never seen this before, but it's kind of interesting. I'll just go through quickly. The annuity, the company we use from the AAA rated company has been around since about 1850. Never lost a dime for a client in any investment account that they have. They're all guaranteed numbers that we're giving you. So they haven't lost money since 1850. They've never lost money, basically. AAA rated company, very solid. You want to be with a AAA company when you're putting a lot of your retirement money in, or all of it, because it just makes sense to know you can sleep every single night and not worry about it. Back in the 1600s, they called them tontines, became popular with the European governments to pay for wars and public work projects, and a tontine gave each participant income for life, with the payments increasing to the survivors as other participants passed away. So payments seized upon the death of all the participants. Can you believe that? So the whole family would just trickle down and get the money from, and those were in the 1600s. In the 1700s, the British Parliament authorized annuity sales. Annuities became very popular among European high society as a form of prevention for a fall from grace and unavailable in other more risky investments. That's in 1700s. In 1776, the National Pension Program for Soldiers was passed in America prior to the signing of the Declaration of Independence. It provided an annuity payment to soldiers and their families, all the way back in 1776. In 1812, the Pennsylvania Company for Granting Annuities was founded. In 1905, a popular name, Andrew Carnegie, established the Teachers Pension Fund in 1905. The eventuality became the TIAA, Teachers Insurance and Association. It's still around today. We call it TIAA-CREF. In 1918, it provides annuities to educators. In 1930s, during the Great Depression, investors looked to annuities and life insurance as safe havens from financial ruin. Isn't that something? In 1930, they were protecting their money during the Great Depression in the annuity. In 1935, President Franklin Roosevelt signed the Social Security Act. Social Security is essentially a lifetime income annuity on its own. In 1940, your friend Jeffrey Ida Mae Fuller became the first Social Security recipient.
Yes.
She receives 35 years worth of payments for a total of $22,000, and started in 1940. In 1952, TIAA-CREF offered the first variable deferred annuity, which enabled educators to invest part of their retirement in equities as a hedge against inflation. In 1986, Congress passed the tax reform that made deferred annuities one of the few financial products where you can invest unlimited amounts and get the benefits of tax deferral. That goes back to 1986. In 2019, the individual annuity sales in the U.S. topped $241 billion, according to LIMRA, which is a life insurance association for insurance. And last year, in 2024, the company that we use, the AAA rated company, had the most life insurance and annuity sales in the world of all companies, period. And in 2024, the total annuity business worldwide brought in over $434.1 billion, B with $1 billion, $431 billion of annuity money. And you tell me annuities are not popular? Come on, guys. This is where your money should be when you're retired. At least some of it, doesn't have to be all of it, but at least some of it should be safe, out of harm's way, protecting and saving your money. Andrew Carnegie saw it back in the early 1900s. We see it all the way through. President Roosevelt saw it in 1935. Creating Social Security. Ida Mae Fuller felt it 4 or 5 years later, and a recipient of the first Social Security check ever. And it goes on from there. Our company's been around, the one that we use most, been around since 1850s. Never lost a dime for an individual investor. Great record. That's 150, 175 years now, going strong. And that's a pretty good track record for me. And the money there, it's got the most liquidity of any annuity I've ever seen right out of day one. It's got the highest bonus of any annuity I've ever seen at 27%. And it's got all the right bells and the right whistles for the master to be very comfortable in talking to you about this product on this show. So 252-249-0100, the number to call. Jeffrey Shade, you're the man right now that's on, the spotlight's on, and tell our listeners how they can reach the master and get all this magic working for them ASAP right out of the box, sir.
That's right, Gary. I appreciate that. And what Gary said was really quite unprecedented. We have never in the history of doing this seen these bonuses as high as 27%. I mean, just do the math. You put in $100,000, you got $127,000. But the thing that we can't guarantee here is that these are going to last forever. So if you're at all interested in getting this bonus or finding out what it's all about, we invite you to call us here at the Masters Wealth Management Group and take advantage of this opportunity while it exists. Our number, 252-249-0100. It's 252-249-0100. Make that call today. It really could make all the difference. Gary, let's take a break. When we come back, we'll talk more about these bonuses and more when Mastering Your Money continues after this.
Ida May, she got her pension check today. In the footsteps of Ida May, millions getting their checks today. She did a little jig, she yelled, whoopee, God bless Social Security, God bless Social Security, I need my Social Security, gotta have my Social Security.
Mastering your money, oh what a show, playing with those figures, making them grow, from pennies to pounds, he's got the flair, Gary serenading without a single care.
We're back. Gary Masterdonato, the Mastering Your Money program. Just a reminder out there, we've been in business for 46 years. We've seen a lot of people come through the turnstiles, if you will, to the master, and not everybody takes our advice. They listen carefully, end up going somewhere else, and then sadly they call us about 5 years later saying, I should have stayed with you on our meetings, and I took a wrong turn. I had a little greed going on, and it didn't work out well, and now we're in trouble here. And plus my health just went bad. And that long-term care plan, how's that looking? It doesn't look good anymore. We took it off the table the minute your health goes bad. And plus you're 5 years older. So premiums rise each year that you wait to get into those things. So, it's easy to do. Just have the complimentary review with us for 22 minutes. It doesn't cost you a dime. It's 252-249-0100. People wonder all the time, Gary, I see a lot of my neighbors and friends here in the neighborhood always enjoying themselves. They're always having fun. The people they know they have pensions. We have a general in the neighborhood, retired 4-star general. And thank you for your service. And Emmett, you know who I'm talking about?
Yes. Mm-hmm.
And Emmett always has a smile on his face. His wife, Linda, do well. And they have a nice, I'm sure they have a nice pension coming in from his work in the military. And overall, they're doing very well. And other local residents here where I live, they're happy. I know they've got lifetime incomes. We have some teachers and some physicians that had the 401ks built pretty nicely in their careers. So nevertheless, people have enough money set aside where they turn it into lifetime income. And I'll tell you, when you have lifetime income coming in that you can't outlive, that takes a lot of stress off the table. Jeffrey and I were talking about taxes right before the show, and the people that go through stresses of taxation, where they're behind on filing their returns, or they owe a big amount to the IRS for past years, whatever the case might be, or current years are not taking enough money out. Regardless, taxes are always on the forefront of our minds. And I'd say that because of the fact that the biggest reasons that people run out of money during their retirement plan, retirement years, are twofold. Number one, income taxes is one. And number two is living too long. We call it longevity risk. And longevity risk is where you're living longer than the life expectancy. We talked about this beforehand, too. At 65 to 95, for a husband and wife, there's a greater than 50% chance that one of the two is going to make it to 95. So better than 50% chance. So Jeffrey said, well, let's win the 50% chance battle and make sure we're on that side of the team.
Right.
Well, we can, just eating properly, having the right kind of food go into your system. Food is your medicine. I saw my doctor yesterday for an annual physical, and he said, you're looking good. He said, you're snug as a bug in your health and everything's looking good. I said, well, Doc, being Italian, I have to equivalent myself to a fine-tuned Ferrari. I got to make sure the Ferrari's running well and getting the maximum efficiency out of the automobile. And that's the body. And I said, I also have no bumper stickers on my Ferrari.
No.
That would be a tattoo.
That would be
on a human.
That would be sacrilege to put a bumper sticker on something like a Ferrari.
I never saw one. I never saw a Ferrari with a
or
bumper sticker.
Even on a Bentley or Rolls Royce.
Except the race cars when they're racing.
Yeah.
Those are bumper stickers.
Sure.
Those are advertisers all over the place. Mm-hmm. And Ferrari doing the F1 very soon here. They're getting ready. They're on a big terror right now trying to win some more races, and they're doing a great job. They got a good driving team. So thank you, Ferrari. Thank you, Italianos out there. So anyway, we're talking about the lifetime income that you can't outlive. We were talking about longevity risk, living too long. And one of the things that longevity risk can introduce or bring on is something we talk about not enough, but another reason that people run out of money from the mathematics. I said earlier in the show that retirement is math and science. I'm a mathematician. I can look ahead and see what the math numbers look like. The science is how long you're going to live. We can't figure out that, and we don't know how long you're going to live. And when we sit down with a new client, I ask everybody, how's your health? It's so crucial and important to know that. How long do you plan on living? Well, I plan on living another 8 years because my father made it this far, and I think I can at least equal out to what he's done. And my mother lived to this number here, but she had some other health problems along the way, so she died earlier. But regardless of the case, the insurance companies, when they do an underwriting, they look at your genes as well, your family history. That's so crucial and important in that kind of scenario. But the math, the sequence of returns risk, we never talk about that enough. I'm going to spend a minute on that because it's so crucial and important. And one thing that the master plan avoids and takes off the table is something called sequence of returns risk. And the reason we can take it off the table is our plans never have any risk. There's no risk of losing any money in the plan. So if there's no risk in losing money, subsequently, there's no sequence of returns risk. So a sequence of returns risk could be this. Let's say you retire in 2026. We're all expecting a great year in the markets. Everything's looking hunky-dory. It's all looking good. And in 2026, for some reason, a whole bunch of things happen that were unplanned, and the economy goes a little bit berserk. The world economy is not doing well as well because we're all very global today. The tariffs have hit in, and some people got the wrong ideas on tariffs, and so did the consumer. And maybe they brought higher rates of inflation up, bringing the markets down substantially, or some other catastrophic reasons, maybe wars that break out that weren't planned. And all of a sudden now you have a down market of 30, 40, 50, 60%. In 2028 and 29, the market dropped 54%. That's half the money you had fell out of the accounts and into oblivion. It's gone. In 2000 to 2002, the market also fell 53% in that time frame. So between 2000 and 2009, we had two major corrections that took the markets down in total of over 100%. And that's a lot of money to lose in 9 years. 100% of your money can be lost. Many people stayed in the plan that they were in. They rode it out. Many people didn't ride it out. Many people are still suffering from those that took their money out or took the losses early because they couldn't handle the ride. The roller coaster got a little rough on the high turns and on the upside down whack-whacks and the sharp turns, and all of a sudden they couldn't take it anymore. The wife would say, the spouse would say, honey, this is driving me crazy. Either you get out of the market or I'm getting out of your life. And I've seen divorces like that caused from, believe it or not, even a down market that's substantial. So we want to avoid that. But sequence of returns risk, let's say in 2026, the markets fall 40%. Well, let's say in 2027, the markets fall another 20%. So that's a 60% drop in 2 years. And let's say in 28 and 29 and 30, the markets rise 15%, 10%, and 25%. And that brings most of the losses back to zero. However, you still got to be invested to get the money back that you're in, but you need a lot more money to go back in than what you did coming out. So if you lost 50% of your money last year, you don't need to earn 50% to get whole again. You need to earn 100% to get whole. You got to double your money, and that's hard to get in 1 year and up 50%. We don't see many years like that. I haven't seen one in a long time. I've been in the business 46 years. I don't remember an up 50% market in my time frame in the markets here. But nevertheless, let's say that occurred. But in between, at the end of the 20-year period, we go and add up the losses and the pluses. And let's say the total return over those 20 years is, let's just say, a number of 5% a year. Let's call it that, okay? And then let's say that we show you a plan like the master plan, and let's say that went up 5% a year every year over that period of time. At the end of the 20 years, your plan that's gone up 50 and down 50 and sideways and over the boards and off the rails, you're out of money in about year 11. Why? Because it's called sequence of returns risk. You didn't have enough money to pay your own self once those accounts fall. Because remember, the account is not only falling, you're taking money out of that account to give yourself income that you need to live on a day-to-day basis. And as you get older, one big thing that happens is your healthcare costs rise. Recently, one of the major banks and one of the major life insurance companies both came up with a scenario differently on different days, but came up with pretty much the same number. The cost of health insurance for a couple that's age 65, if they live to age 90, per person is $290,000 per person out of pocket or with coverages. $290,000. And a lot of that is not covered by health care. If some of that is long-term care coverage for a facility, none of that is covered. You're totally 100% out of pocket after a certain amount of days on Medicare. And there's cutting those days down, by the way, drastically. So those plans are changing right now as we speak to how many days Medicare will cover long-term care needs in the home or in a facility. So we talked earlier, also you want to be able to stay in your own home for a position for a change of health where you don't have to go to a facility. Facilities are probably the last place you ever want to be in, but you end up having to go there out of necessity. Your spouse may have died before. You might have divorced and gone into retirement single. You might have not any family left that's able to take care of you. You're not going to sit there in the home alone and wither, so you're going to go somewhere. And if you got money in your retirement plan, that's the money you're going to spend. And eventually you're going to run out of that money. But you can also run out of that money along the fact by pulling extra money out of that plan to pay for health care, but also by market losses along the way that becomes disastrous. And then you have that too dreaded word called income taxes. Those are rising as well. For the older generation as well as younger, taxes are increasing to rise. Why? We have a deficit of 36 trillion, I think, Jeffrey. Is that where it's at?
Yeah,
now?
that's right about what it is right now. 36 with a T.
Yeah, 36 trillion with a T, my Jeffrey says. And I trust whatever Jeffrey says, I trust.
Hey, I've got the computer right in front of me here. I'm just looking it up.
You can take that right to the bank. I'm telling you.
Sure.
So 36 trillion deficit. So we got to pay the interest on that. Taxes aren't going down, folks. They're going up. Services in the country are rising. We're giving more services out. You got to have higher taxes. So do the math. I mean, it's very simple. It's not complicated, but the master wants you to be able to retire with dignity, stay retired with dignity, and stay on your game with dignity all the way through. So that's why we set up the master plan in the way we did. Our plan will cover all the different adversities that you can face in a retirement plan. You're not going to run out of money. You're not going to run out of money from living too long. Your family's not going to have to reschedule and move by dying too soon. We got all the boards covered if your health changes, if you need more income for emergencies, if you got a family member that counts on you for special needs, whatever the case is, we have a strategy that'll portfolio and pretend to fill all of that up nicely so that there's a solution for almost everything that can occur between now and the day you die. And our clients stay with us from the day they retire to the day they die. And we have, unfortunately, 2 or 3 clients in this past week right now that are all in hospice at the same time. Sadly, one of my best friends, and just a matter of days before their last breath occurs. So, we got to be careful what we do. And some of these people are younger than life expectancy gives them the chance to live. Some are dying too soon due to cancer. Some are dying too soon due to other health problems. One's got colon cancer at 61, type 4. He's got about 6 months to live, if that. And it's not a good scenario. And so, people die for different reasons along the way. The Lord has the plan that and when he's ready to call you home, home you go. So the number to call, 252-249-0100. Let us help you to help yourself. Let's keep you on the right track at the right time. Let's take the risk off the table. We can take the majority of your risk, which you don't maybe feel you got right now. Ladies and gentlemen, you've got risk. You've got risk. You've got big risk that you're not aware of, or you're blinded to it because you don't want to look at it straight out. But take a good look in the mirror and sit down with your spouse, if you have one, and say, honey, let's review with the master. Let's give him 22 minutes and see how he would approach our situation with a good financial planner who specializes in retirement distribution. The number to call is 252-249-0100. That's 252-249-0100. Myself and my entire team, we have a giant team, and we got 12 of the best coaches in the United States, All of us working at the same time for the same cause to keep your money safer along the way and to make sure that you never, ever run out of money during your lifetime. 252-249-0100, Jeffrey.
And Gary, for those people who do not have the opportunity to hear the entire radio show, earlier in the show today, of course, we were talking about these unprecedented bonuses that we're getting on a particular insurance product, an annuity. So I want to remind people that if you can imagine locking in an extra 27% in bonus money to your retirement dollars so they could work harder for you, not Wall Street, would you be interested in doing that? That's right. These bonuses are unprecedented. In our history, we've never seen bonuses this high. So if you want to find out more about that, get your dollars working for you. Give your retirement a jump start. More guaranteed income for the future. Call us here at the Masters Wealth Management Group, 252-249-0100, and learn how you can take advantage of these record high bonuses while they last. Once again, it's 252-249-0100. Gary, let's take a break. When we come back, we'll wrap it all up when Mastering Your Money continues after this.
Mastering your money, oh what a show. Playing with those figures, making them grow. From pennies to pounds, he's got the flair. Gary's investing without a single care.
We're back. Gary Masterdonato, the Master Your Money Show. We covered a lot of topics today. Good topics at that. And we talked about the bonus annuities. They're 27%. My gosh, I never saw that number before on any annuity in my entire career. 27% on $10,000 or more. That could be qualified money, non-qualified money. Don't be shy. If you're 74 years old or younger and you qualify, we have to run you through suitability and compliance to make sure you're good to go on that. But most people can do that. It's all age related. Up to 74, it's 27%. From 75 to 78, it's 22%. And above 78 to 83, it's 6%. But still, the 6% is better than a shot in the foot because you get a 4% guaranteed 1 year as well. So that's like a 10% in year one. That's pretty good. You're not getting 10% now, no matter where you're at. Plus, we keep your money safer. So 252-249-0100. You know, Jeffrey, in the final few minutes of the show, we get asked this question a lot. Gary, should I convert to a Roth IRA? Is this a good time to do that? I hear a lot of things about Roth. It's tax-free growth. There's a lot of pluses and minuses on the Roth. I'm just going to give you a quick overview on my thoughts on Roth. I thought Roths are great ideas if you're younger, if you're putting money into a plan right now, you're in your 30s, 40s, 50s, still a lot of time to recuperate. Remember, if you convert money from a traditional IRA to a Roth IRA, whatever you convert in that particular year is 100% income taxable to you. So it adds to your tax bracket in that year. So we have to look and see how your health is, how much longer you expect to live, at the same time to make sure you can cover the payoff period on the taxes. It may raise your total tax bracket to 25, 30, 35, 40, 45% federal and state. So that's something we have to look at. But, you know, my thought is, if you want to move money, the best thing you can do to move money from your present traditional IRA to a Roth IRA is to put it on what we call the Roth Steroid Program, which is our special plan for long-term care. Now, you don't want to hear about this plan all the time, but ladies and gentlemen, if I had to choose one plan in my whole toolbox for financial advice to anybody, if you're healthy and can afford the payments of the premium, and we help you do that through our special annuity that has a big bonus on it, I would use the plan that we use for long-term care. It's Roth on steroids. Why is it Roth? Because when you pull the money out, either through long-term care needs or death, it's 100% income tax-free, just like your Roth would be. If you're going to pull 10 grand a year out or 20 grand a year out to convert, I'd rather see you put that into the life plan, pay the premium with that, and create maybe $300,000 or $400,000 or $500,000, depending on your age, which was never there before. We can create money that wasn't there before. Example, you retire with a shortfall in your retirement plan goals because some people don't have the money built up. Some people say you need about $1.2 million, $1.3 million for a decent, comfortable retirement. That doesn't pay all the bills, but it pays a lot of them for you. And most people don't have $1.3 million in their pension plans or in their Roth, in their pension plans at all. Their IRAs, total them all up, they don't hit $1.3 million, husband and wife. So what do we do? So we can create money that wasn't there before with our master plan. Creating money that wasn't there. How do we do that? Well, it's a drop of ink in a piece of paper and a sign of good health, and away we go. And If we were to dig deeper into the subject of taking a Roth IRA conversion versus the plan I'm showing you, which is the master plan, will win every single time. Doesn't matter how long you live. You die too soon, you live too long, it'll win every single time. There's a few key differences between a Roth and a traditional IRA. Of course, on the front end, there is the same issue of tax deductibility. Contributions to a traditional IRA are tax deductible currently based on income, while Roth IRA contributions are taxable. So you place them in after you've paid the tax. So that money then grows totally income tax free. The tax on a traditional IRA is deferred until you start taking withdrawals. However, all earnings and withdrawals in a Roth are growing income tax free. Assuming no rules or regulations have been breached, in short, you're paying tax up front with the Roth, but owe no taxes later when you take the money out. Converting to a Roth basically locks you in at the current rate taxes are in and protects you from future tax increases. Another important difference is that traditional IRAs allow holders to withdraw beginning at the age of 59 and a half and require minimum withdrawals by age 72. The Roth, on the other hand, possesses no mandatory distributions during the lifetime of the original owner, and the Roth gives you the flexibility to decide when and how much to take out, depending on your individual tax and financial situation. And in addition to that, since you can leave the Roth assets in place for the rest of your life, they can provide tax-sheltered growth for your family as well. Untimely, the optimal choice is clear. You should definitely consider converting to a Roth IRA. However, what I just said about leaving Roth assets in place for the rest of your life can provide tax-sheltered growth for your family as well. The master plan can do the same thing, and your family receives the money 100% income tax-free, federal and state, just like a Roth would. Difference is this. The Roth IRA is worth whatever you put into the Roth IRA and the growth that it gets, if any. If you risk some of it, you can actually lose some of that too if you put it into the wrong investments. Our plan, the money is guaranteed to be there the day you need it, whether the day you die or the day you get the 2 of 6 and you can't perform. The ability to get yourself dressed, that's 1 of 6. Get yourself out the door on time by yourself, that's 2 of 6. Mobility, get to the bathroom on your own, that's 3 of 6. Getting in or out of the shower, that's 4 of 6. Preparing a meal for yourself, 5 of 6. And eating on your own without help from anybody having to feed you, that's 6 of 6, as an example. Basic things you and I do every day we take for granted. But on the same token, mentally, if you have a mental acuity with Alzheimer's or dementia, you only need the 1. You don't need the 2 of 6. 1 of 6 is fine. So that's kind of a quick overview of Roth or traditional conversion. If you have a question, we have a special calculator that we use that's designed by Dr. Larry Kotlikoff. It'll give us the best way to approach it, and that can be instrumental in helping you make that right choice from a mathematician standpoint, that's mathematical, and from an economic standpoint, that's financial, and that together will make the right decision for you if it makes best for you. So we talked about as much as we can talk about on the show. We're about out of time. We want to thank you all for listening to the Mastering Your Money Show. We're going to close with a prayer, as we always do in every show we've had for 43 years, and today will be no different. Heavenly Father, we thank you for this day and thank you for the opportunity to get out of bed today and to do and help other people to follow your will. And we thank you so much for all the favor you've given us, the gifts and the enjoyment along the way. We thank you to really look over those that are ill today. I've got 3 very close friends that are in hospice. Please help them get through their transition in the best way possible with the least amount of pain. If that's your choice, to bring them home. We believe in you. We have faith in Heavenly Father. In Jesus' name we pray. Amen. Jeffrey Shade, thank you, sir, in the other room. You help us every single time, and you are the man that I cannot do the show without.
Gary, thank you so much. Always a pleasure.
Remember, behind every good producer is a very surprised mother-in-law, okay? And we thank Eric, who helps us out daily from his perch in California. You better be working, my son, if you're listening. I can tell. And all of our team, we got 12 of the best coaches. We got 22 people that work for us off-site. They're our back office, if you will, and they are instrumental in our success. And we thank you all for listening to the Mastering Your Money Show in our 43rd year. See you all again next time, right here live on the Mastering Your Money program.
No statements made during the Mastering Your Money Show shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on your individual information. Past performance is not a guarantee of future results. No investment strategy, including asset allocation or diversification, guarantees a profit or the avoidance of loss.